Today's lesson will focus on determining revenue growth rates. Revenue growth is the biggest driver of company value. If a company isn't growing its revenues, its value will diminish. So, focusing on the top line and what will drive a company forward is the best place to start analyzing any company. If the company doesn't drive revenues, the margins suffer, free cash flow, etc. To estimate future revenue growth, yes, estimate. Unfortunately, there is no surefire way to estimate how much a company will grow unless your crystal ball works better than mine. We have three methods we can use to estimate our future growth rates. 1. Historical. 2. Analyst estimates. 3. Fundamentals. Historical growth rates tell us how well Google performed in the past. We can use these rates to project the potential for future growth. However, we must understand the past offers zero assurance it will continue. For example, Google has grown revenues over the 10 years at 18.33%, over 5 years, 18.5%, and over 3 years, 20.37%. Outstanding stuff, and we could average those rates and use 19% as our revenue growth estimate. Using FinChat, free by the way, we can see Google has compounded revenue growth at 18.52% over the past 10 years. Next, we have analyst estimates. If we consult a few websites like Seeking Alpha and Yahoo Finance, we can see both are estimating revenue growth rates over the next 3 years of Seeking Alpha at 11.3% and Yahoo Finance at 11.3%, exactly the same. A word of caution with analyst estimates. They are often wrong. Using them as a reference point is best, not the end be all. Analysts have access to management and are smart people for sure, but we have to be mindful of the incentives. Because of their close relationship with the companies they follow, analysts can offer negative takes on these companies for the risk of losing access. The third method is utilizing the fundamentals of the company. Before we dive in, here are a few acronyms and their definitions. EBIT equals earnings before interest and taxes, also known as operating income. NOPAT equals net operating profit after taxes. ROIC equals return on invested capital. CapEx equals capital expenditures. Net working capital equals current assets minus current liabilities on the cash flow statement, indicating liquidity. Okay, a little math here, but I will walk you through the process. A few formulas first. Growth estimates equals ROIC times retention ratio. First, we can find ROIC or return on invested capital on our favorite financial website, finchat.io, and Google's average 5-year rate equals 27.6%. The retention ratio is a bit more involved. Here goes. The retention rate is the percentage of a company after-tax operating income allocated to capital expenditures and net working capital. It measures how much of a company's earnings are reinvested into the business to support growth and generate future profits. The formula for measuring the investment rate is retention rate equals net capex plus net working capital divided by NOPAT, where net capex equals PP&E minus depreciation, net working capital equals the change in net working capital, NOPAT equals EBIT times 1 minus the tax rate. NOPAT up first. NOPAT equals EBIT times 1 minus the tax rate, which we can find on the income statement or here on FinChat. Next, to calculate NOPAT, we find the operating income by taxes to get the tax rate and fill in the numbers like so. Now we can determine the rest of the formula as such, pulling from the cash flow statement. From the operating section of the cash flow statement, we have depreciation, changes in net working capital. We achieve changes in net working capital by adding up the highlighted items from above. Items such as other operating activities, change in accounts receivable, change in accounts payable, and so on. Very important, because working capital investments are cash flows taken out of operations to fund the growth of the business. We must take changes in working capital and multiply it by -1 to get investments in working capital. If a company has a positive change in working capital, especially over multi-year periods, this means that the company generally doesn't have to invest cash flows into working capital to grow, but instead receives cash flows on its working capital, sort of like a free float. So investments in working capital equals -1 times changes in working capital. Thus, the changes in net working capital in this case equals a positive $7,278 million. And from the investing section of the cash flow statement, we have CapEx, or capital expenditures. Now let's plug some numbers into our formula. So the retention rate equals giving us 36.1%. This means Google reinvested 36.1% of its after-tax operating income into the business through capital expenditures and net working capital in the trailing 12 months to support its growth and generate future profits. Now we can multiply our 5-year average ROIC of 27.8% by our retention ratio of 36.1%. So the growth rate gives us 10%. After doing all the math, we can take our 3 estimates and determine which is most likely. Historical growth average is 19%, analyst estimates was 11.3%, and our fundamental growth rate was 10%. Here is where some common sense and an understanding of the company can come in handy. For example, it is possible that Google will grow at 10%, but the historical averages seem a bit high considering the headwinds in AI and advertising. To me, averaging out 3 estimates and determining if they are appropriate will work. If we average the 3 ranges, we get 13.4%, which seems possible. But again, estimates. Your guess is as good as mine. So that is what we'll go with, but you can feel free to disagree and use a different number. Congratulations, you now know how to determine a company's growth rate when valuing Google or any other business.